Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back for another edition of Investor Stories. On this special segment, the experts describe the most important lesson that they've learned and how that has changed the way they invest. This is the special segment called Lessons Learned. On today's special segment, we have Brian Requarth of Latitude. Brian, can you tell us a story highlighting a critical lesson that has changed the way you invest?
A critical lesson that's changed the way I invest. Something that has changed the way I invest. I mean, I think that the biggest influence on my investing has just been having the good fortune of being on the other side of the table with incredible investors, right? I've had the good fortune of being very close with Mickey Malka, who's the founder of Ribbit, and just seeing the lessons and kind of how his framework for thinking about things and the questions he asks. So I don't know if there's one particular lesson. I do think that there is one lesson that just strikes me that I just thought of, is that I think that there's a tendency to, when you're an outsider, we're kind of outsiders, right? Like, we're not from the typical kind of Sand Hill. And I think that it gives you an awesome perspective about underestimated founders. And if you look at kind of a lot of the big stories, they're underestimated founders many times. And so I think it gives you pattern recognition on people that you would maybe not have in a kind of a traditional scenario.
On today's special segment, we have Mehta of ENIAC. Nahal, can you tell us a story highlighting a critical lesson that has changed the way you invest?
A critical lesson that has changed the way we invest. I mean, I think rules are meant to be broken, just kind of dovetailing on what I previously said with Pinterest and us being too myopic on or too stringent on our mobile rules. A rule that was broken that ended up working out is we had a rule against doing uncapped notes, because you have no idea what they're going to convert at in the next round. You end up investing, you end up helping the company, and your help is actually a detriment to the valuation that you convert at, right? Mm-hmm. So the more you help, the less ownership you're going to have.
Sure. Unless the discount is 50%, it doesn't make sense.
Exactly. And so we're very anti uncapped notes. And so we had an uncapped note on our table, in 2015. And we're like, I don't know about this uncapped note. And we ended up breaking the rules and doing it. And thank God we did it, because that was attentive. And so rules are made to be broken, and I think you should never really be too rigid. It's good. Discipline is good. Focus is good. Building up your muscles is good. Becoming an expert is good. But we're in the business of outliers. And so remember that when you break the rules, you have more access to outliers.
On this special segment, we have Seth Levine of Foundry Group. Seth, can you tell us a story highlighting a critical lesson that has changed the way you invest?
Well, the story about Jonathan perhaps is one of them, right? Which is that valuation's important, but it's not the only thing. And I think earlier in my venture career, I was more focused on that because I came from this finance background, and not that I ran tons and tons of models as a venture capitalist, because as an early stage investor, there's not a ton of modeling to do. But I think I was more focused on that. And now I find myself more focused. And we actually ask these questions to Foundry as we get to ultimately making an investment decision. What do we need to believe in order for this to be a successful investment? Mm-hmm. That's a much more important question than should the valuation be X or Y. Now, I mean, in this market environment with valuations really, really high, we have to talk about valuation. And that question tends to be more around, do we think this is a valuation that the company can raise at later, right? Because we've certainly been around long enough to have seen a lot of businesses and a lot of founders push valuation in the early round, make good progress, but not enough progress, and then kind of be stuck because they've got this high valuation that they didn't grow into. So that when we talk about valuation, we tend to talk more about that. But the real question I think a VC should be asking themselves is, what do I need to believe in order for this business to be successful, and meaning a successful investment that produces an outsized return?
It's so tough, right? Because when you have a thesis and your thesis is dependent on, you investing at certain ownership levels, and that determines kind of a valuation range, right? And it determines your check size. And those factors determine your portfolio construction. Here's how many deals we're going to do, right? All those factors, they kind of structure a thesis, and you're selling a thesis. Here's what I'm going to invest in. You start violating that by doing way bigger checks to get your ownership, or way less ownership. It starts to make LPs uncomfortable. But I think what we've seen since we started this program, I think on episode 5, we talked about the unicorn report. At the time it was, $1 billion outcomes. There were very few of them. And now it's not about $1 billion outcomes. There's multi-billion dollar outcomes. So as the size and scale of the exits have changed, it kind of trickles back and really, sort of changes the foundation of portfolio construction.
This may be blasphemous, Nick, but I don't subscribe to the ownership theory, if you will, right? I mean, obviously, dollars in, dollars out, right? That matters. And as part of that, valuation ends up coming into play, but I don't think about it from a ownership perspective. And I think that's a mistake for VCs to get stuck on that. And frankly, I think that the LP community should stop pushing on ownership levels, because I don't believe that that's a good metric. Right now, if you have a large fund, you can't invest $500,000 or $1 million at a time, but it's less important what your 5 million bought you as a percentage of the business. It's much more important that you put 5 million in and you got 50 out, right? Or you got 100 out, or you got 30 out. That's what drives return on the fund. And I think ownership ends up being a bad proxy for opportunity and risk assessment. And so I think that's what people should be talking about. It distills into ownership. But if you have an ownership problem, there's only a problem if your risk assessment is wrong, which means the valuation or the opportunity don't justify the dollars that you invested. So that's how I think about it. I mean, and again, if people want to say ownership's a proxy for that, I guess, but we've actually been having this conversation at Foundry because like most venture firms, we traditionally had talked about having meaningful ownership, all this kind of stuff. I don't subscribe to that anymore. I've been arguing internally that that's not the right metric. We should be talking about how much, what are the dollars we're putting in, and what do we think the opportunity set is for generating return, and then what do we need to believe in order for that return to materialize.
Blasphemy, Seth. Blasphemy. I love it.
Crazy.
We got to have Michael Kim on, and we'll have a good debate between the two of you.
I would love to talk to Michael about it.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.